Preparing for the future starts with a choice. Choose growth with My Choice Investment. Discover investments suited for your aspirations. Invest within your budget and get started easily for as low as 1,000 pesos. Enjoy convenience with professional fund managers and an auto invest feature. Access investments anytime, anywhere with Metrobank Online. With diversified products that suit your risk profile and investment horizon. Tap into local and global markets using Philippine peso and US dollar funds. Invest today, be empowered tomorrow with My Choice Investment. Visit your Metrobank branch now or add to your portfolio via Metrobank Online.
Good afternoon, ladies and gentlemen. Welcome to the first quarter review. It's Market Landscape, Insights and Outlook. I'm Don Hernandez and I will be your moderator for today's webinar. It has been a challenging start of 2022 for all of us, right? We have the conflict in Europe, we have rising inflation, we have still the COVID-19 pandemic, right? And in this webinar, a little different format, we're going for a panel discussion with our esteemed panelists. And I do believe that this will keep you abreast with what's happening in the market and help you adjust to the situation and spot opportunities for your investment portfolio. Before we begin, may I remind everybody that you can put your questions in the Q&A box in your Zoom platform. We will be answering that in the Q&A session or the open forum later after the panel discussion. So to kick off today's webinar, we have our first speaker. I would like to introduce you to our speaker who is the current market strategist of the financial market sector of Metrobank. He joined Metrobank in 2016 after 14 years working in Singapore and London as Director of Asian Equity Sales for UBS, Credit Suisse, and Bank of America Merrill Lynch. Ladies and gentlemen, please welcome Mr. Ruben Zamora. Ruben, the floor is yours.
Hey, thanks, Don. Good afternoon, everyone. Thank you for joining us. As Don said, it's been a very challenging start of 2022. We actually came out thinking that the worst is over for a 100-year event when we enter the new year. But very quickly, things have turned south for many different reasons. So I'll kick off really the first quarter review with, can we flash the slides perhaps? Yeah, there we go. Okay. Maybe we can kick off with how we're looking at, some of the economic metrics, what Metrobank's forecasts are. Next slide, please. We're looking for growth, to continue accelerating from that recovery that already started last year in 2021, but that downward arrow is recognizing really the new headwinds that have come up with really inflation and which and higher, really driven by higher energy prices, which is considered to really be a tax on growth. So that's where the growth risks are, but we do kind of see some resilience in our economy and going through next year. But it is inflation that is the major concern. We did have relatively high inflation last year of 3.9%, but this year will be potentially much higher. For now, we're looking at an average inflation rate of 4.6%, and that to kind of remain somewhat in that range through next year. The policy rate, we do expect some normalization of the policy rate of the BSP, which is the reverse repurchase rate, the RRP. 2% is really meant to support growth, but as growth has picked up, we do see some adjustment in the policy rates. But again, that's something that we might have to look at more closely as the U.S. adjusts their own policy rates in the face of rising inflation, which we'll discuss later on. And lastly, just in terms of interest rates, we do we've already seen a big adjustment in the 5-year yield and across really some of the things we look at, the yield curve, the Philippine government security yield curve. We do see that rising further throughout. That's a year-end number or forecast for us this year and next year. And lastly, the dollar peso. We do see that continuing to rise for many reasons and the pressures on the local currency. Next slide, please. Again, turbulence in global markets because risks and uncertainties on many fronts have really caused turbulence in the market. So we do know where crude oil prices have gone, and the red kind of diamond there indicates where we are currently. But it's just massive, 70+% price difference year to date for oil. And all or most of the risk assets have been substantially weaker year to date. Really, if you look at it, it's gold, safe haven, that's really outperformed. We can kind of look at the PSE is flattish, and to a certain extent has outperformed. So maybe we can talk about that in more detail during the panel discussion and the Q&A. Next slide, please. It is the, as I said, inflation that is of the most concern. Oil price surge, as Don said, the Russia-Ukraine conflict was a black swan event. We are in 2022 and Russia invading its neighboring country is not something that people really kind of expected. We kind of moved away from, or we were in the process of moving away from a global pandemic and repairing a lot of the damage caused by that, the scars of that, and here we are very soon after. And that's really kind of caused, this volatility in oil prices, and that's thrown a lot of the uncertainty in markets. And there's kind of up and down. The pluses and minuses do refer to what's driving prices up and what's pushing oil prices down, including the lockdown of China. So those are kind of factors that have just kind of thrown a lot of uncertainty and therefore caused a lot of turbulence in markets. In fact, turbulence in overdrive is how I'd frame it. Next slide, please. So inflation, and this is the inflation story in the US. And we know very well that the last print was over 8%, which is a 40-year high. And the components in the table next to that, kind of indicate what the drivers are of how they got to 8%. And next slide, please. So from this inflation shock, we're going towards a policy shock in the sense of what the U.S. Central Bank, the Federal Reserve, will have to do, is being forced to do, to try and arrest and tame inflation. And forced to do really is really more aggressive policies than what we've seen before. Again, very, very loose, very kind of supportive of growth policies, historic low interest rates in the US. But the exit used to be very gradual to try and support the recovery globally, not just in the US. But with inflation at a 40-year high in the US, they've kind of 180-degreed that, and now will have to really catch up and be very, very aggressive. The red line in this chart is the inflation story that you saw, but going back to 1992, really. But the green line, the dash green line, is this rapid catch up in interest rates from historic low levels. So that's the policy shock that global markets are trying to deal with now, and again, turbulence in financial markets as we started the year in the first quarter of the year. Next slide, please. When we look at what is happening at home, however, relative to what the Fed has to do, is forced to do, we're still, the BSP is still very much more in gradual withdrawal of these accommodative measures, as Don said in his introduction. there really is still a pandemic going on. We'd like to think that it's the worst is behind us, but are we really sure? Even our BSP Governor Diokno has reiterated that he is very much looking to keep an accommodative policy, monetary policy, to continue to support growth. Again, Philippines was later to the party in terms of recovering from the pandemic than the developed markets, the US. So therefore, some of the withdrawal of these accommodative measures is a lot later than what the US Federal Reserve has already done and will continue to do. Again, they already hiked rates in March. They've already signaled for further rate hikes over in every meeting. That's the second line there in the table above the chart. Next slide, please. So there is that divergence. But as I said, GDP growth is kind of recovering. We do see a return to pre-pandemic kind of the size of the economy, getting back to the size of the economy here in the Philippines pre-pandemic this year. But higher energy prices are a significant headwind. And again, the tax on growth. So that's the growth risk. That's that downward arrow that we kind of had in the forecast slide. Next slide, please. Again, of course, the election is an event that's in a few weeks' time, so that tends to, support growth. That is more private sector investment specifically. We've seen this in every election cycle. So that's supportive. That's a tailwind for growth. But again, conditions are a lot different this year because of so much uncertainty and geopolitical risks at the global level. Next slide, please. Again, a signal that things have been recovering. Loan growth is an important metric that we look at because again, that means more activity, economic activity after a lot of contraction in the size of the loans outstanding in 2020. Some pickup last year, but clearly the trend is encouraging, and that's again a signal of economic growth, and things are kind of growing. Investments are rising again. So there are good signs of growth locally, but we are takers, not givers. We have to take what energy prices are doing. We have to import all the oil we use locally. Next slide, please. So there is upside risk to Philippine inflation, and I actually use the reweighted CPI basket here to kind of contrast that with the CPI basket in the US. Really, our CPI for March is 4%. We're not at 8+% like the US, because again, the drivers of our inflation are very, very different from the US. The risk is, of course, that we can go higher. And our current forecast is the average inflation rate will rise this year. Will rise to 4.6%. It's currently doing about 3.6%. So we do, and next slide, please. I think we do recognize that energy in the March print, inflation print, energy was really the key driver of almost 54% of the total increase in inflation in March was because of higher energy prices. So, we do have tailwinds for growth. We are seeing good and much better economic activity this year. But what's going on with global inflation? And as takers of global commodity prices, particularly energy and oil, not to mention food and rice prices in particular, those are commodity prices that our economy will have to. So those are growth headwinds. So we really have to kind of look at the rest of the year as a challenging environment for growth, even though there are a lot of tailwinds for the recovery. Next slide, please. So in terms of the yield forecasts of Metrobank, we do, as I said, see the yields across all tenor buckets, both short and long end yields, to rise. Now we've the dark line there is the end where yields were at the end of last year. The blue line is where we are currently. So it's actually risen by quite a bit already, and many factors there that includes the likely rate hike increase by the BSP or lift off in the second half, which we now think is actually going to happen in June, which is late first half. And also more borrowing by the government because the government is still in deficit spending mode. Deficit spending equals support growth. But we do see, so we care about where yields will go because as yields go up, prices of bonds fall. The value of the bond portfolio does fall if rates continue going up. But we do see kind of some peaks in yields through the year, perhaps because of inflation peaking later than initially expected. We'd want to be catching peaks in yields when inflation is showing signs of rolling over, of peaking. But we would look at bonds this year and be opportunistic on bonds as yields look to peak and really in turn because of inflation potentially peaking this year. Next slide, please. On dollar peso, again, our forecast is 53.40 by year end this year and exceeding 54 next year. A lot of it is really because of the sensitivity of our current account balance to oil prices. Our sensitivity work suggests that if oil stays above or within the 120 to 140 range, we're about $100 right now. The peso is susceptible to weakening to 55 pesos. Right now, it's at 52.50. And again, our year-end forecast is 53.40. Next slide, please. There is also the pressure from rising US rates. If we're later, as I said, if the BSP is going to increase rates at a later stage, which is already the case, and at a slower pace than the US Fed, that does apply upward pressure on the peso and a stronger dollar against the peso, as we've seen historically when the Federal Reserve, the US Central Bank, starts hiking rates. Next slide, please. In terms of the PSE, equity valuations do look undemanding. It's basically flat, little change year to date. And valuations, and I think the team of our other panelists, Mr. Garchitorena here, for the valuation charts, but they do look undemanding still relative to history. So we do think that should inflation kind of calm down and earnings growth remain positive and robust, and there's resilience in the economy. Again, we do have elections as a trigger if history repeats itself for private sector investment. And that should, again, continue to support earnings for the companies in the PSC. Last slide for me is the next one. And there is also support for the stock market because of very low foreign ownership. I think we've, Rafa can probably talk about this later on a bit more, but we are at or near historic lows in terms of what foreigners hold in the Philippine stock market. We never say no way else but up, but it does look like there's less downward pressure for the stock market from further foreign selling because of how little they own of the market. Sorry, this wasn't my last slide. My last slide is just a repeat. Next slide, please, of our forecasts, just to kick off the discussion in the panel. Again, we are looking for continued recovery in the economy, but there are headwinds in the form of inflation, and really because of commodity prices. We are seeing an increase in the policy rate for the BSP, but that'll lag the US and therefore apply pressure on dollar peso. We are looking for rising interest rates still, but not as much as what we have already seen the previous year, and the peso to continue to weaken against the dollar this year and next. That ends my presentation, Don. Thank you very much.
Ruben, thank you. Really appreciate every time you're presenting your outlook. Very insightful. Now, again, let me remind everybody that you can already post your questions in the Q&A box in your Zoom platforms. It's located at the lower portion of your platform. We have colleagues in the background who's also responding to your questions via chat, but we will also discuss some of the questions later during the open forum. So as the panel discussion goes, you can already put them there so we can take a look at it later. Okay, now let's move on to the highlight of this webinar. We're going to tackle relevant issues related to the investment field, related to what Ruben had also mentioned a while ago. And to start our panel discussion, I would like to introduce you to our panelists today. Of course, let me call back Ruben to join us as our first panelist. Hi, Ruben. To join Ruben, we have with us Dondi Santillan. Dondi has more than 30 years of professional experience, having worked as a fixed income trader and eventually heading the trading desks in Singapore and New York before settling back here in the Philippines, where he now serves as Senior Vice President and the head of Metrobank Trust Banking Group. Hi, Dondi. Good afternoon.
Hi.
Hi. And also joining us today is our esteemed guest, Rafael Garchitorena. Sorry about that, Rafa. Rafael Garchitorena. Rafa is the Chief Strategist and Co-Head of Research of Regis Partners Incorporated. Rafa's experience in the equities industry is extensive. He began his career as a research analyst at BZW in Manila from 93 to 98. He then worked for WI Carr as an equity salesperson based in London from 1998 to 2002. Rafa joined Regis Partners Inc. as a senior analyst and industry specialist in April 2002, covering the Philippine banking and property sectors. While he continues to cover the Philippine banking sector, Rafa is now principally responsible for the company's overall equity strategy. Hello there, Rafa. It's always nice to have you in our webinars. Welcome back.
Thanks for having me. Always a pleasure.
All right. So we're going to start off our panel discussion here. It's going to be very interesting for everyone. I hope this helps, guys. And we're going to try to start light. It's a bit theoretical, no? It's about inflation. Ruben had some pieces a while ago about inflation. And for the first timers in the audience, Ruben, can you help us understand first, is inflation good? Some are saying inflation is bad because it's really just price increases. But theoretically speaking, is inflation good? When is it good and when is it bad? Could you give us some thoughts on that?
That's not a light question. Okay, inflation is one sign of growth, right? That's when it's good because there's demand driving it. So if it's demand driven, that's a good sign. And a lot of the inflation pressures we felt really globally initially in advanced economies last year was because of a resurgence of demand when supply chains were really constrained. So that's abnormal. And I think that's the reason why the monetary authorities kept thinking and saying it's transitory. As supply kind of chains unlocked and get uncorked, things will kind of settle back down. So demand driven, that's good. I guess inflation, when it's running too hot, which is where we are now at 40-decade high in the U.S. specifically, and we're not far from our at least 4-year high now. At potentially at around 4%. We peaked at around 6.7% 4 years ago in 2018 during the rice supply issue we had, which is again a local, not global problem. That's when things get a little harder, because it's exactly what the Federal Reserve and maybe to a certain extent our central bank has to do, forced to do, which is really to kind of tighten and tighten really aggressively to arrest inflation, runaway inflation. Inflation is a very slippery slope. Once it starts, the second round effects kick in, and then it just kind of snowballs into something a lot larger, and that's why you have central banks in the first place, which is to keep inflation in check.
yeah, basically, if I read it correctly, I mean the acceptable level of BSP in terms of inflation for Philippines is still 2 to 4%, right? Now, you mentioned somewhat a while ago some drivers that we're trying to look after. Dondi, in terms of looking at these drivers, what do you think should we be watching out for? I mean, Ruben mentioned a while ago, but can I hear your thoughts about it?
Sorry, what do you mean by drivers for inflation or?
For inflation, what's driving the CPI number up? BSP said it's around 2 to 4% is acceptable, and right now Ruben's saying that we have around up to 4.6% that will.
Yeah, I guess the thing is it's really a global phenomenon. No?
Yeah.
8% in the US is unheard of, at least within the recent history. No? They normally print around 2% and they're quite stable there. No? Remember, we just came out of the pandemic. During the pandemic, there was problems with shipping, with logistics, and then we enter into 2022 just as we see the pandemic sort of easing, and people started getting hopeful. Then the conflict in Ukraine. The conflict in Ukraine is resulting in higher oil prices, as Russia is one of the biggest oil exporters to Europe and the rest of the world. But even with Ukraine, you'll also see disruption in other commodities like fertilizer, which feeds into food, which is one of the biggest components of inflation in the Philippines. As Belarus and Russia are one of the bigger fertilizer suppliers in the world. So yeah, first we had the pandemic. Just as we're getting out of it, we got the Ukraine conflict. So not good for the supply side.
Yeah, that's really something that we should watch out for. Thanks for your thoughts, Dondi. How about you, Rafa? Are there other things that we should watch out for? I mean, locally, we do have oil prices. I mean, the gas prices in the stations are everybody's being caught off guard, right? But is there a deeper thing that we should look after? I mean, is power next? What are the things that we're gonna look after?
It's a lot of things. I think Ruben put it very well during his presentation. That as a country, and this is something I like to tell a lot of foreigners is, the Philippines is a price taker, as Ruben mentioned. We don't really produce things, right? As a country, we produce people. It's the one export we have is labor, but we import. The obvious one, as you mentioned, the obvious one is oil, and eventually power, energy. If oil price goes up, coal prices go up, not gas prices go up. So all sorts of energy prices go up. As Dondi mentioned, now you're talking about fertilizer and agri products. Indonesia just stopped exporting palm oil, and palm oil and all edible oils feed into all of our food products. And the problem with the Philippines, as I mentioned earlier, is we import everything, not just oil. We import corn, wheat, rice, steel, cement, cars, iPads. So, as the whole, so nagkasabay-sabay na, di ba? It's you have the issue of demand recovering even domestically, but at the same time you have the what was supposed to be a transitory supply chain issue now compounded by the geopolitical nonsense going on in Russia and Ukraine. So it's a bit challenging. Obviously, power rates will have to go up. There's many issues to look out for. It's probably better to start off on the bad news before going to the good news later. But there are lots of issues. Obviously, power rates will go up as coal prices go up. We're also having a big resurgence in demand for power. The latest data point for first quarter, Meralco said power sales were up 6% in the first quarter. So mahal na nga yung kuryente, may chance pa na may brownout pa tayo because demand is running very hot in terms of growth in demand but there are no new power plants coming online for the next 5-6 years. So there's lots of challenges coming up, and it's very frustrating. Kasi nga, as Ruben pointed out, we're late to the growth game. It was supposed to be a fantastic year for us. This was our year. Everyone had their growth year last year. Dapat tayo na ngayon. But being so subject to the vagaries of global market pricing,
Yeah,
it is what it is, right?
fate had other plans for Philippines.
Kawawa naman tayo.
Oo nga eh. Well, yeah, thanks for your thoughts, Rafa. And going back to, mashing up yung information you from Dondi and from Rafa. Inflation basket is about 30% food and fertilizers that was mentioned by Dondi. That's something that we really have to look out for. Power, probably 10 or 15% of the basket. Those are the things that will definitely affect inflation, the inflation numbers that will be printed out over the next few months. And Ben, a while ago, you were mentioning that interest rates will be something that the central banks will be using really to curtail inflation. Dondi said US has 8.5% inflation, and I think Germany and the other European countries already have 5%, 7%. The Fed is is the institution that a lot of central banks are looking after, right? What is the Fed doing? They're planning to raise rates like 8 times yata until next year, no? I guess
10 times.
10 times. Sorry, my bad. Yes. So I guess it's really hawkish or very aggressive in layman's term, no? And I guess my question to you, Ruben, is that even necessary, right? Even with inflation, with inflation being worrisome, it's really right to increase interest rates, but is 10 too much? Is that aggressiveness something in your thoughts necessary?
The market seems to think so. That's what the market's pricing in, and the guidance is that they'll do whatever it takes to tame inflation. Listen, this is the one and only real mandate of every central bank, the Fed being the first one, really, is to make sure that inflation doesn't go crazy. Well, it's late. It's 8.5%. And so a lot of that is really signaling. Remember, the Federal Reserve, just like the BSP, they have every monetary authority has a lot of tools in their toolbox, and rate hikes is one of them. A lot of it is really signaling the market, we will do whatever it takes to arrest inflation, even if it's like just to hit the brakes on demand, if that's what it takes, just to pull back and drain liquidity from the system. Because again, more liquidity in the system tends to be an inflationary. So you kind of try and arrest inflation that way. And if you have to hike in every meeting and hike even more than 25 basis points, which is kind of the high sequence that they tend to follow. Again, the next one it's next week's, diba, Rafa? May 4 yata yung FOMC. It's 50 basis points. So they've got it. They were 2 points. It's one of my charts, but they were 2% when their growth was already skyrocketing, and then inflation was skyrocketing. That's not the right policy rate. They were ahead of everyone in the growth party, and yet they kept, they were very, very sanguine about inflation. Again, because to a certain extent, they got used to 2%. As Dondi said, diba? Dapat 2%. Yeah. Paano yung 8.5%? Diba? So,
they got stuck to the word transitory, no?
They did, and so they had to reverse it. A lot of it, and it's if you remember in July 2020, the Federal Reserve Chairman Jay Powell actually came out saying, we want the economy to run hot or overshoot. They actually changed the formula of how they looked at inflation. If you remember, again, because that was their way of saying, we're gonna keep policies really loose and accommodative, ultra dovish. Markets love that, but they obviously didn't anticipate the the level of demand come in, surging back all at once when ports and semiconductor factories weren't ready because they're all in zero COVID China. And then energy. I mean, gas prices were $70-80 before Ukraine. So it's already kind of done. So yeah, to your question, sorry, didn't want to overextend it, but yeah, is it necessary? I think it is. And they're not just raising rates; they're also selling bonds. Used to be just kind of letting bonds, not buying or refinancing bonds, right? But they're going to be selling bonds, but to the degree of $95 billion a month. So they're really going to shrink the balance sheet. That's also whatever it takes to arrest inflation.
Thanks, Rubes. Dondi, Rafa, do you guys have anything to add to that? I guess the point in question is it necessary? I mean, a lot of analysts are saying that, growth will be affected in the end, right? Some are even fearing recessions. Recession is coming back to the US, probably 2024. Is that something that you guys are also worried about?
If I may chime in lang on inflation.
Sige, boss. Go ahead.
It's interesting how, the US is at 8% and we're still at, the last print was below 4, right? 3.4. Huh?
Flat 4.
Flat 4.
Q1 is 3.6, I think.
Sounds like a disconnect now, why we're not going up as fast as the US. And I think Ruben's slide shows that the baskets of the Philippines and the rest of the world is quite different. It would be interesting to see if we follow the US basket, what our inflation will be. And I can tell you it will be higher than 4 because it's very heavily skewed towards oil now. Talking about oil, I didn't think I would see $100 in my lifetime, with all these electric vehicles, everybody getting rid of internal combustion engine type cars by 2025, 2030. That's Norway and Paris and France. So you would think, $100 on oil back then, I don't think that will happen. But here we are at 100. If Russia stops exporting, they stop exporting to Poland and forget the other country. But if they stop doing it to the rest of Europe, imagine where oil will go. Now, I heard somebody say $200 per barrel. I read an article.
Yeah.
But the thing with inflation, I think let's also remember we also had an inflation bout in 2018 when inflation hit 7%. I think that was because of food, which our basket is dependent on. But the situation back then is quite different for the Philippines. Back then, time deposit rates were at 7.5%. Banks were desperate for cash. They were issuing bank bonds left and right. Loan to deposit ratios, at least when I look at Metrobank, and I remember the rest of the bank as well, we're almost 90% loan to deposit ratio. Right now, we're probably closer to sub 70, in terms of loan to deposit ratio. So there's a lot of cash. Time deposit rates, in fact, some are still below 1%. So it's different from the 2018 experience. Except this time, it's really global.
Yeah.
It's really global. And the problem is, when the Fed moves, we cannot not follow.
Cannot not follow.
Yeah,
that is true.
We have to follow suit and increase interest rates. It's just a matter of how delayed we're going to increase it. It's just a matter of how aggressive or less aggressive we are to increasing it. So we don't have a choice once the Fed moves because they're the market we follow and we're pegged versus the dollar. We have to follow suit.
Yeah. It will follow.
No,
Rafa.
it's a challenge. It's an extra challenge for the central bank. No? Kasi nga, when your economy is running hot, then you can step on the brakes to slow things down. But when you're just about to get, parang palabas ka pa ng garahe, preno ka na agad, di ba? The US already on highway speeds. So for the difficulty for us, and a big challenge really for the current central bank, and obviously the incoming government will be whoever that might be, is you don't want to slam the brakes too hard now, right? The economy is just coming back from from COVID. plus, and I have some sympathy for Gov Diok's perspective. Parang the US is very monetarized, right? Everybody has household debt, everyone's got bank debts, mortgages. Here, the financial impact, the financialization of the Philippine economy is not really there. Parang yung punto nga nila is, what will raising peso rates do to the price of oil? Nothing, right? And so, and we're lucky. So just one quick footnote to what Dondi was saying earlier. The one good thing for us, touch wood, is the Rice Tarification Act brought down their price of rice, right? So because that's such a big portion of the CPI basket, that's serving, thankfully, to hold prices down a little bit domestically. It's the one thing that the average Filipino doesn't have to worry about, is the price of rice. No? But so it's a unique challenge for us, and I guess to everyone's point, hindi naman pwedeng mag 10 rate hike si US na 2.5%, 2% pa rin tayo. Hindi naman pwedeng mas mababa yung policy rate ng Pilipinas kaysa sa US, di ba? But the question really will be how far behind the curve the central bank in the Philippines chooses to be, right? I mean, we can be a little bit behind the curve, but we can be too far behind the curve. And of course, and this is all your closed systems, right? So if you don't follow the Fed as quickly, then your escape valve is the currency, and that's going to be the where the pressure will be. And don't forget, I mean, we keep saying that 10 rate hikes is high, but think about it. In the Philippines, pre-pandemic, our policy rate was 4.
Yeah.
Right? So just getting back to normal is
That's 8.
It's actually
Yeah,
8, yeah.
Right? And that's just to get back to normal,
8.25%
right?
increase, yes.
825
Alright.
basis point
So
increases. Yeah.
it's a huge challenge. It's a huge challenge, and how do you balance the need for growth, the need to keep employment up? You borrowed a lot of money. You can't slam the brakes on the economy now. You need the economy to grow. So it's a unique challenge for, again, we happen to be price takers. So it's just one of those things. It'll be a very delicate balancing act in the next 6, 9, 12 months.
Thank you, Rafa. Thanks, Dondi. Thanks, Ruben. Can we translate all of these into how our clients can, move into their in their investment portfolios? No, probably I could ask Dondi this one. You used to be a fixed income trader and heading the fixed income desks. A lot of some of our clients are living on interest, with interest rates being priced high already. Is it something that our clients can already consider to enter and get some interest in their portfolio?
I think the one thing that's sure from Ruben's slide is interest rates are going to increase.
Yeah.
I think your outlook is from 5.2 to 5.77, 5 years or something, right? So
yep,
50 basis points. Like I said earlier, this is different from the 2018 inflation bout. No, back then you can place time deposit at 7%. So the smart thing to do back then was to park your money in time deposit. Right now, parking your money in time deposit is sub-inflation. So over time you lose value. So the sad thing about 2022, there doesn't seem to be any home run trade, at least for the Philippines. No, in fact, globally. As well, no?
Yeah.
And in fact, why our weighting is a little heavier on equities is we still see at least Philippine companies to have decent earnings growth this year, and we're seeing it so far. So that should reflect in the price action and where the index will close. So I think we favor equities a bit. Fixed income's interesting. Whenever I look at a yield curve, I always think what part of the curve I'll buy.
Yeah.
When you see a 1% differential between 5 and 10 years in the Philippines, that is interesting. Take note that the 5-10 curve on the 10-year, 5-10 curve on US Treasuries is negative, meaning the 5-year rate is higher than the 10 years. In the Philippines, for some reason, the curve is always steep, no matter what, which it shouldn't be. That's why banks like gapping, meaning borrow short, lend long, right?
Yeah.
Imagine if you can borrow at 2% 1 year and lend at 6% or 6% 10 years. That seems interesting.
Yeah.
Unfortunately for investors, they go one way. They just lend, right? They just invest. So if you're just a one-way trader, meaning you can borrow and lend, I guess the thing is, I think you have to wait for yields to stabilize towards where we expect it to be. Placing it in time deposit will not, although it sounds safe, you will lose parity value over time. There's some interesting trades there. In fact, and Rafa knows more of this, but REITs is also an interesting space. So those are the real estate investment trusts that are listed on the stock exchange. That gives quite decent yield, and unlike fixed income, at least based on the pipeline of the sponsor, your coupons or dividends tend to go higher year on year because of escalation and additional inputs into the REIT. No? So yeah, I'd be a little more equities. Start looking at fixed income, but not now, a bit later. Look at fixed income alternatives like REITs. If you really want to play safe, time deposit, but that doesn't earn you any money right now.
Yeah.
Yeah,
Agree.
Yeah.
All right. And Rafa, would you like to second that? It's well, this year is an election year, right? So tied with all the headwinds that we have, this year being an election year, what do you think? Where do you think PSC on a a chief strategist standpoint, in the broker's perspective, where do you guys see PSC going for this year?
Yeah, tough one. Before the Ukraine invasion, we were looking at high 7,000s, low 8,000s for the year end. And that was purely on earnings growth, right? And what's frustrating again is, we've been talking about the reopening trade for a while, and the reopening trade is real. It's absolutely real. We've had more than a dozen CEO calls already. We have our CEO series of calls. Fabian was one of them, one of the earlier ones in April. And every single one, 100%, walang mintis, every single CEO is bullish this year. Okay, bullish top line. Sales are going gangbusters, right? SM Prime came out a couple of days ago saying 85% na yung mall traffic. I just came back from Coron. The flights were full. Hotels were full. May espas na yan, ha? Tas kamahal-mahal pa ng tickets, puno pa rin yung flights, right? There is revenge travel. And people forget, and people underappreciate, for a country of 7,000 islands, domestic tourism is huge. And unlike every other country in the world, we are, I think, the only country that closed domestic borders, right? And you talk to Cebu Air. Cebu Air is saying that forward bookings are now over 100% of pre-COVID levels, PAL's at 80-85%, right? So these things are real. The economic recovery on the top line is real. And again, the problem that inflation and global commodity prices is bringing is that the margins are getting squeezed, right? So the companies are trying to absorb as much of the cost increase as possible para hindi ganun kalaki yung lipad ng presyo to the consumer. But after a while, they've got to pass it on, right? So that's really what's taken down a little bit our outlook on the PSEI, precisely because the earnings are now not as good as they were. I think we started the year with earnings growth estimates of 25% or higher. Now we're mga 15%, precisely because the likes of URC, Jollibee, and all these guys will print very strong revenue growth, but some might even post earnings declines as a result. So all that being said, there are a couple of things that could be positive. One, Ruben pointed out, I just came back from the US and the UK for the first time, meeting investors face-to-face in 3 years. And the interest, I think siguro, I'm guessing we 40% of clients we saw actually owned Philippines. Many used to own Philippines, but now they're saying, oh, pwede na ba? The prices are low, the recovery story is real, or are there any stories out there that would be independent of politics, independent of the currency, independent of inflation na pwedeng tingnan? So there is interest. But I think what's more interesting really is to Dondi's point. I think the domestic institutional investing and retail investing market is big and growing. And with interest rates going up, now's not the right time to start buying bonds. Not yet. At some point will be. And yes, quite apart from REITs, there are some companies giving out very, very nice dividends. There are, if you wanted to play the commodities trade, there are companies out there that you can buy. Maybe it's too late for coal, I don't know. But clearly there are ways to hedge yourself in the equities market the way you can't really do in the fixed income market. At least not here. There's no short domestic. So,
okay. All right. Thank you, Rafa. Thank you, Dondi. Thank you, Ruben. It's actually a very fruitful panel discussion. Now to liven things up now, let's. I'm going to read some of the questions here in the Q&A. This will actually complement our panel discussion a while ago. And, some of these are very interesting. No? So this is already the open forum section. Guys, if you have questions for the audience, please type it in the Q&A box. We will be answering your questions, whether live here or through our colleagues who are chatting the responses. No, I think Ruben, you got the first one. One of the first questions that we've seen was, do you think that the peso depreciation will continue? Where do you think the dollar peso will be? I think you've shown it in your forecasts a while ago, but are we seeing just an intra-year spike, or will this be sustained over the next 2 or 3 years? What do you think about the dollar peso, Ruben?
Yeah, weaker peso. I think we were clear with the first slide. And that our forecast is 53.40 by year end. We're north of 54. It's from our economist. 54, I think 30. I think in end of next year. We're at 52.50 because the BSP has. Am I allowed to say this? They're around. They're managing the volatility of the peso, and we do have natural kind of, well, at least sources of dollar flow and supply, and Rafa mentioned it, right? It's the BPO and the tourist guys. People. We export people is what Rafa said. So we have that, but. If the Federal Reserve is going to hike all the way to 3% from what is now 25, 70, 50 basis points, that's and we're going to be behind the BSP again, balancing act that Rafa mentioned between growth and just trying to support that and not hit the brakes when we're just leaving the garage. That's going to again. The pressure will hit the currency, and that's our view. Right now, it's being managed, the volatility, and rightfully so, I think, because weaker peso equals higher inflation. We import everything, as we've been saying this afternoon.
Yep.
So yeah, the outlook is probably, if you have dollar requirements, look for hedging solutions.
Mm-hmm. All right. Thank you, Ruben, for answering that question. And one of our friends in the audience, Dondi, I think this one's for you. In the news, Deutsche Bank is predicting a recession in the US. How will that affect the dollar peso exchange rate versus our forecast that Ruben just said? No? Can I ask for your thoughts, Dondi?
I'm not an FX person. Ruben will be able to answer that. Yeah. The one product I never traded was FX. So I don't want to give an opinion.
Okay, sige. Ruben, would you like? Yeah.
No, in the end, a recession in the US might force the Fed to slow down the rate hikes, right? They might not be able to be more aggressive. So which should be favorable for us, even if we're slow and they're slow, then It's just at par. Remember, the depreciation, theoretically, the peso should always depreciate versus the dollar because they look at interest rate differentials, meaning our interest rates are higher than theirs, right? So over time, if it's a 2% differential, over time, the peso should depreciate by 2% per year, theoretically, right? So like Ruben said, depends on how aggressive the Fed is. If there is a recession in the US, then they cannot be as aggressive with rate hikes, which means then that should not put as much pressure on the Philippine peso, because if the BSP decides to go slow on the rate hikes, that's fine. It's just at par with the slowdown in the Fed rate hikes, right?
Yeah. Thanks, Dons. Ruben, would you like to add to that? Or
Yeah. If I may, just real quick.
Sure,
No,
go ahead.
because right now the forecast is for the at least the Fed funds futures are pricing in, this big, like I said, 10 hikes until through next year, but then cut following those. This is really condensed tightening cycle because just to kind of tame inflation. So for sure, listen, BSP Governor Doctor has his work cut out for him. Can you imagine the work cut out for the FOMC and Jay Powell? Because they're very, very late. They procrastinated. It's obvious they wouldn't have kind of about turned the language if they were kind of aware of what kind of policy was right, I guess. But it's going to be tough for them to engineer a soft landing. It's going to be a slowdown. It's very clear to us, but is it going to be recession equals a contraction in the economy, negative growth, right, for 2 consecutive quarters? Are we there? We don't know. So it's going to be it's a challenge for the Fed to engineer soft landing is where we're at right now.
Thank you, Ruben. Thank you, Dondi. Now, Rafa, this one's for you. We've mentioned a while ago about REITs, and one of the questions here is basically, we've been telling about some defensive positions. So the question was really, which sectors in the Philippines can they invest their money now? If they're stuck in equities, which sectors do you favor, at least over 2022?
Well, the easy one. Okay, so there's several ways to play this now. So if you like we do, if you believe that the recovery story is real, in a normal time you want consumer companies. But medyo sablay kasi their cost pressures are hurting their profits. So the way we're looking at it is by the banks, right? Loan growth is picking up, NPLs are coming down. If rates go up, then banks can raise their rates, then margins go up. There are some banks that are taking a lot of digital initiatives to bring their costs down while their revenues are going up. And banks don't have a currency problem; they don't have an inflation problem, right? So it's one of those sectors, and it's a regional global theme, right? So the banks have already outperformed so far this year. They outperformed last year, and I think for as long as inflation and currency are a concern, then the banks are the easy way to go. Metrobank stock, for example, is still below book for a top 3 bank. Fantastic asset quality, great earnings growth, etc. That's the easy one. So for the recovery play, near-term banks is the sector we're pushing. If your crystal ball tells you that global prices start falling tomorrow, then you start buying the crap out of URC, Mondelez, Jollibee, etc., right? Because typically what happens is they raise prices slowly habang mabilis yung angkat ng costs, and then when costs roll over, they keep raising prices, right? So you'll see an era of super normal profit naman following the collapse in interest rate, so of inflation. So that's the way we're looking at the reopening. The other things we look at are longer term trends that are independent of the near term challenges. So One of them would be digital financial inclusion, for example. So we would love to have had GCash listed by now, right? So financial inclusion, fintech, all these things, e-commerce, sayang lang wala pa tayong listed sector. We're not as hot on the REIT thing. I guess it's different. I mean, in a normal market, rising interest rates should theoretically be very bad for REIT prices. But as Dondi says, there's really no outlet for retail investors. You can't borrow cheap and lend long. So REITs might be a good place to hide, at least near term, until you think that the fixed income market is right to switch from equities.
Yeah, Rafa, thanks. Actually, the next live question here is very interesting. And Ruben and Dondi, you can probably put your thoughts here. Do you guys see the local finance industry trying to support the burgeoning electric vehicle industry by making it easier or cheaper to borrow money for electric vehicle purchases, charging stations, dealerships, etc.? Or will they approach EVs the same way they approach the traditional auto market? What are your thoughts on this question? Very interesting.
I think that's an ESG question.
Yeah.
If you look at the initiatives globally, in China, do you know that to get an ICE or internal combustion engine car, there's a 1 in 200 chance that you get a license for your car. If you buy an EV or electric vehicle, there's a 1 in 2 chance. So they're obviously trying to push people to get electric vehicles. In fact, the biggest electric vehicle market is in China. You look at Paris or France, rather, they're going to get rid of ICEs by 2030. Norway by 2025. When you look at the ESG initiative or the environmental, what's the S?
Sustainability.
Social.
Social.
Environment, social, and governance.
Yeah. If you look at the ESG, Europe's in the forefront. Unfortunately, in emerging markets, it's not yet a big thing, although there's a lot of pressures for companies listed, including banks, by regulators to be more ESG compliant. So we have to see the government push that. We have to see the government push that and to give incentives for you to buy electric vehicles, for you to lend to electric vehicle companies, etc. So it has to be government-led.
Got that.
Yeah.
Thank you, Dondi. Ruben, Rafa, you want to add something on that? I have a follow-up question actually on that one as well. No, maybe you can tie it up here. Are technology and/or innovation companies still or good investments rather? I mean, in EM, Dondi's in Dondi's statement, malamang baka hindi pa masyado until governments come in. But I'm assuming this question is more on a global perspective. Technology and/or innovation companies still good investments. I mean, we've seen growth stocks being battered also for the year. No, well, what are your thoughts on this?
Okay, so being old and ugly and cynical, right? So over the last 5-10 years, you're like, eye roll for all these whatever astronomical prices people were paying for some in our day we call them concept stocks. But and that made sense when money was free, right? When the Fed funded was zero, obviously borrowing is free, so anything that can promise you fantastic revenues now but profits later, okay lang, you can wait, right? Because there's no cost to holding onto the money or to hold onto the investment. Now that rates are rising, things are different. Never mind the whole growth trajectory, but really now there's a cost. There's a real opportunity cost. You want that you will no longer say, okay lang yan, I'll wait 10 years for a company to become profitable. Hindi na pwede. That window shortens or shrinks very, very quickly. That being said, I mean, obviously there are tech companies with real business models, with real profits today. I think it's just going and again, I don't think you've seen the end of a lot of these venture capital, angel, mezzanine series, ABC financing. You're still seeing it. Gcash raised series funding early last year. Bank is just coming out now. You've had funding rounds for the likes of Grocery of Robert's Retail, Paymongo, and all these things. Meron pa naman. But I think the point is that as money becomes no longer free, money becomes a little bit more choosy, picky in terms of what things to fund. So yes, there's still, like I said, even just talking to the investors over the last couple of weeks, Indonesia was well ahead of us in terms of listing the tech sector. Again, some were getting kind of crazy. There was one bank that was 20 times book value, just ridiculous. No? That stock's obviously come crashing. So yeah, I mean, there is still demand. There are real stories that are worth funding and worth riding on investing.
Thank you, Rafa.
Yeah.
Okay. Yeah, Dondi, you wanted to add something?
Yeah, I think it's interesting when you say innovation and technology, they're not necessarily the same, no?
Yeah.
It's interesting, let's say, going back to EV, no? Tesla in March 2020 dipped to $70 per share. Right now it's 1,000 plus. That's why Elon Musk is the richest man in the world, because of the stock price, right? And you look at mid-2000s when you're talking about smartphone, everybody thought the smartphone that will succeed was BlackBerry, not Apple. And BlackBerry defaulted. Remember, that was also BBM, no? The BlackBerry Messenger. Yeah. It's interesting how, you'll get some clear winners and losers. But at the time when the technology is being developed, or the innovation, you're not sure which a clear winner is. Right now, Tesla was a clear winner. 3 years ago, it wasn't. 3 years ago, it wasn't. That's why it was trading sub 100. Right? So if you get into those type of names, I think you have to go through professional fund managers. I think it's a long-term investment. I mean, you saw Alphabet, if I could have invested in Apple, Facebook, Alphabet 10, 20 years, 10, 15 years ago, that would have been the perfect trade, right? But I don't know if I'll be able to spot a BlackBerry, in the market. So not everything is going to be a gold mine. So if you're going to get into innovation or technology, or the early technology, I suggest you go through proper fund managers. Don't trade the stock individually, because it's hit or miss, basically.
Yeah. Thank you, Dondi. Thank you, Rafa. Thank you, Ruben. And it's already 4:08. I don't think I have much more time here. I guess it's one. I can read one more question here. Regardless of who wins, I mean, this is an election year, and this is to address the elephant in the room. Regardless of who wins in this year's election, what do you think the administration should do to further strengthen the foreign investor confidence in the Philippines? It's really what we really need right now, right? So what is that? What do you think, in your opinion, could strengthen the foreign investor confidence in the Philippines? This is an open. Anyone can respond to that.
If I may,
Go ahead, Ruben.
No, again, from the perspective of the fixed income market, both local and offshore fixed income market, what we need to do, the next administration has to really address our debt to GDP levels, and that is important for our sovereign credit rating. We, I think, need to at least maintain our investment grade rating, because that's really cheaper, a lot cheaper funding for growth. And we're a multi-decade kind of growth country. We get that because of sheer demographics, but we need kind of that support to fund that growth, and investors to really kind of be comfortable holding our debt, and it has to kind of be investment grade is a big priority for, I think, the next financial managers of our economy. So that's important for me.
Thank you, Ruben. Any more thoughts?
For me, it's like, again, whoever wins. What's absolutely crucial, especially as we've talked about, we're at a situation where daming problema, you have inflation, currency, etc., etc. I think the key challenge with whoever wins is to come out very strong, very early, with a credible economic team, with a credible economic platform, and a responsible economic platform. Regardless of what you thought of Duterte when he won in 2016, everyone was freaking out or whatever. But when the economic team came out with their, pretty conventional and orthodox 10-point economic program, if you let the numbers speak for themselves. Look at the capital formation as a share of GDP, right? Actually kept going up. After 2016, it was actually highest in 2018 or 2019 before the pandemic. It was actually higher than Aquino's presidency. So it's always important to have the investors, both foreign and local, confident that there are grown-ups in the room, right? To temper the political whims of whoever sits, right? So regardless of the political stripe, and the difficulty now is syempre election period, so everyone's talking of populist game, cut oil taxes, subsidize agriculture, more education spending, etc., 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 which is all fun and good, but as Ruben points out, we had our debt to GDP rise from 4% to 60%. It's not critical, but our budget deficit is not the best. So this is not the right time to be spending your whatever little bala you have on subsidies, right? Maybe it's more important to create jobs and to continue the infrastructure spending, and to have very credible, very responsible, fiscally responsible economic programs that hopefully are still sort of populist and still expansionary, without being profligate. It has to be responsible spending. Spending is good, particularly to kickstarting the economy, but it has to be responsible, so the foreigners, even the locals, don't freak out. You don't want capital flight. You want the locals to buy in, and believe in the country, that yes, we can get out of this ourselves.
Understood. Thank you, Rubes. Thank you, Rafa. Okay. Dondi, can I just ask for some final thoughts before we close the Q&A? I guess that is what do you think is when we're looking at all these headwinds, is it prudent to still be defensive? I guess this is for our audience. Is defensive the right strategy as of the moment for all your for the investment portfolios? That would be the final question before we close.
When people, when I think you have to have strong hands.
Yeah.
I keep telling this story. If you overtrade, meaning you keep on getting in and out of the market, it actually destroys value over time.
Yes.
Let's say an investor says, let's talk about the stock market index. Let's say they bought at 6,000, they sold at 7,000, and the market continues to go up. You can't really buy at 8,000. Human nature will not allow you to. Or even 7,500. You will always want to get below 7,000. Likewise, If you bought at 6,000, you sold at 7,000, and you say, I'm gonna get back when it dips. If it dips by 2,000 to 5,000, let's say, human nature will not allow you to buy that because you're ruled by fear.
Yeah.
You know, so over trading the market is not also good. But at the same time, I have to say you have to be defensive though. Defensive meaning be careful and do your homework. Do your homework. But at some point, markets get cheap and don't get scared to buy.
Yes.
Right. So what I'm saying is don't overtrade the market. It destroys value over time. I gave a talk to my parents, friends in Bel Air, the Bel Air seniors. They said, the best investment I ever had was property. My dad bought his property at 200 pesos per square meter in 1972. Now it's 400,000, no? And you know what I tell them? You think, and that's true. Property is a really good investment. But you know why it tends to be good? Because you can't really trade it around. You just sit on it.
Yeah.
You whether the price goes up or down, you just sit on it until eventually it goes up, right? Because of scarcity. It's not like land is increasing, right? So that's what my suggestion to people, think about it like property, or think about your property investments. They tend to increase. It's because you're not too worried about the mark to market. You just wait it out because the exit and entry cost is expensive.
Yes.
It's not that easy to exit and enter. Plus, sometimes you live on the property, right? So it's not that easy.
That's Thank you.
Over trading can be bad, but yes, be defensive. But don't be scared if it falls too much to enter the market.
Thank you for your thoughts, Dondi. I really appreciate that. So before I go to the last part, Ruben, Rafa, Dondi, I really appreciate, the audience really appreciates your presence here. It's always nice speaking with the three of you. Thank you for letting me pick your brains during the discussion and for responding to our clients' questions in the Q&A. So thank you very much, Ruben, Rafa, and Dondi again. Now, before we move to the last part of the program, would appreciate if you guys could spend a minute or two of your time and answer our short survey. We'll be flashing our QR code on the screen and just scan the QR code to access the survey. Your feedback would be very helpful as we continue to improve our webinar series. So again, thank you to our panelists for giving us insightful discussion about the market. And of course, to our audience who joined us this afternoon. We are looking forward to see you in our next webinar. This has been your moderator, Don Hernandez, and I thank you, and please do have a wonderful afternoon. Keep safe.